Welcome to This Explainer. We often treat the stock market like it's this giant math problem we need to solve. But actually, scratch that. It's way more like a psychology test. And it's one that most people fail, literally every single time. Today, we're going to break down exactly why the vast majority of investors lose money and, more importantly, how you can use a bit of structured, logical analysis to make sure you end up in the profitable minority.
Let's kick things off with Section 1, the ultimate investor trap. Studies consistently show that a staggering 80% of individual investors underperform the market over time. 80%, that is a massive number. And look, it doesn't happen because these folks aren't smart or because they skipped doing their fundamental research. No, it happens purely because of how they react when the pressure is on.
So you have to ask yourself, why do so many highly intelligent people do the exact opposite of what they should? Well, they end up buying high when the market looks incredibly safe, and they sell low when things get really scary. And it's all driven entirely by two dangerous, very primitive emotions, fear and greed.
Which brings us to Section 2, the emotion cycle.
The psychological roller coaster that traps that 80% follows a very distinct, predictable flow. The crowd starts off with optimism, right? That builds into a thrill and eventually reaches sheer euphoria right at the market peak. But here's the thing you got to remember. Euphoria is maximum risk completely disguised as safety. Then the drop starts. Anxiety sets in, followed by panic, and finally capitulation. That's when the last desperate sellers just throw their hands up and quit at the absolute bottom. Ironically, that exact moment is maximum opportunity disguised as extreme danger.
The whole crucial point here is captured perfectly by that famous Warren Buffett rule. Be fearful when others are greedy, and be greedy when others are fearful. The emotional crowd actually gives you a highly accurate roadmap. They're telling you exactly where the market is. But to be in that top 20% who actually succeed, you must have the iron discipline to look at that roadmap and go the exact opposite way. It feels incredibly uncomfortable, for sure, but it is absolutely essential.
All right, let's move on to Section 3, the VIX fear gauge. Enter the VIX. This is essentially the market's built-in fear gauge. It tracks how much insurance professional traders are buying against a sudden market crash over the next 30 days. When traders get spooked, they buy options to protect themselves, and boom, the VIX goes up. When they're totally complacent and relaxed, the VIX drops.
And these historical VIX zones give us a really clear instruction manual. A reading below 15 means the market is overly complacent, and you need to be cautious. 15 to 25? That's just business as usual. But a reading above 35 signals absolute, widespread panic. Historically, that means the market is near a significant bottom, and you should be getting ready to buy.
And the proof is right there in the history. Massive VIX spikes in 2008, 2020, and 2022. Those weren't signals to run away and hide forever. They were hidden invitations to buy. Think about it. If you had the discipline to step in when the VIX spiked to 80 during the 2008 financial crisis, you would have seen a 60% return on the S&P 500 over the next 12 months alone. Panic creates life-changing returns for those who just remain calm.
Now for Section 4, the 4 stages of reversal.
Every major reversal throughout history, whether it's 1929, 2000, 2008, or 2020, they all follow these exact 4 predictable stages. Understanding this sequence completely removes the surprise and gives you a clear, objective strategy to navigate all the chaos.
We always start with Stage 1, euphoria. This is when the market is priced for absolute perfection. Everyone feels like a total financial genius. The news is just endlessly positive. But underneath the surface, the smart institutional money is quietly heading for the exits. This is, without a doubt, the absolute most dangerous time to invest.
Then, some catalyst hits, and we enter stages 2 and 3, the snowball and capitulation. This is when the 80% start to completely panic. Forced selling triggers margin calls, which triggers even more selling. The snowball just keeps rolling downhill until it hits capitulation. Desperate sellers dump everything they have on extreme volume, and the headlines are utterly apocalyptic. But right at this moment of maximum darkness, central banks and governments finally step in to fight fire with fire.
Finally, we hit Stage 4, light at the end of the tunnel. The general public? They're still terrified. They dismiss the new rally as a dead cat bounce and demand absolute certainty before they even think about buying back in. But here's the secret. The stock market is a forward-looking machine. It's already looking 6 to 12 months ahead.
By the time the public finally feels safe again, the market has already heavily rewarded the 20% who bought during the panic.
So, moving on to Section 5, Real-World Market Signals.
Now you might be wondering how to spot this without staring at charts all day. Well, by just observing the people around you, you can spot the market's exact mood. We can compare peak consumer spending, like impossible-to-book packed restaurants, against phenomena like the lipstick effect, where during a recession, people stop buying big-ticket items and only treat themselves to small, affordable luxuries. Let's look a bit closer at euphoria signals. When your dentist, your grandmother, and your Uber driver are all enthusiastically giving you stock tips, you need to be very, very careful. When every free investing seminar is standing room only and your social media feed is overflowing with newly minted, boastful millionaires, it's a massive red flag of market complacency. Public participation is just completely maxed out. Conversely, look for those depression signals. Sure, you'll see daily mass layoff headlines. But you know what the most telling indicator is? Complete silence. When everyone in your social circle totally stops talking about their stock portfolios, and the only narrative you hear is extreme doom and gloom. Believe it or not, that deafening silence is actually your loudest buy signal.
And that brings us to our final part, Section 6, the contrarian advantage.
The market is essentially a giant pendulum, and it always swings to extreme fear or extreme greed. The few investors who actually succeed over decades aren't necessarily the ones with the best math skills or the fanciest algorithms. They're simply the ones who recognize which extreme the pendulum has swung to and proactively choose to act against the herd.
So I want to leave you with this provocative thought to chew on. Take a walk outside today. Based on the real-world indicators in your own city right now, are we surrounded by blind greed or paralyzed by irrational fear? Figure that out, and you'll know exactly what to do next. Thanks for joining me for this explainer. Remember to keep your emotions in check, and I'll see you next time.